Good morning. It is April 6, 2023, and we're going to continue on the talk about doomsday signals because there's a lot of wood to chop here that I think you'll be interested heading into earnings season if you're concerned about the drop in earnings as we are. Today, we're going to talk a little bit about the global PMI signal. So again, if you're on the Longbow Dashboard, you can scroll down and see all the different signals and the stock price charts and the index charts and the data charts below it. And the one that we're going to be talking about here is at the bottom. It's the monthly PMI. We're showing you what the PMI levels are, but what goes into the doomsday signal, it's actually a calculation that's proprietary that looks at a few different things. It's the absolute level and it's the change in that level, especially relative to historical periods. And so what does that mean? Let's unpack it in some plain English here. And that is, we really look at the Purchasing Managers Index, that's the PMI, which it's the index of prevailing trends in the manufacturing and service sectors. The purpose of PMI is to provide information about current and future business conditions. And again, what we'd look at is the absolute level of that figure, as well as the growth rate and direction of it, because it's meaningful. It was interesting, Goldman did a study on this years ago, and I think that they did a great job. It took a lot of data, a lot of analysis, and it came out to where we come out, which is, call it when the global PMI is above 50. You can argue, is it 50, 52? Public markets have a much greater chance of positive returns. And that's because things are solid, you're on a upward growth trajectory, you're not going negative. But when the global PMI is below 50 or 52, and that means that things aren't as good. So the global economy is weakening. So that's the first thing, is you look at the absolute level. And then we talked about looking at the growth rate and direction. So if you're above that 50, 52 level, are you going up? So is it going from 52 to 56? Or are you going down? So were you at 53 and now you're at 51, going to 49, going to 47? So you're looking, are you moving up, improving that number, or are you decelerating in terms of the growth rate decelerating and or declining in the absolute number? So those are the types of things that we look at, because when it's above 50, 52 and going up, tends to be very, very smooth sailing for equity markets and all risk assets overall. That's because things are good and they're getting better. But if you're kind of at that 50, 52 level and things are getting worse, so you're going from 51 down to 48, 47, makes it seem like, oh my gosh, things are actually getting worse here. But we want to caution, because what happens when you're below that 50, 52 level, but things are getting better? You actually can have really good returns of risk asset and equity returns at that level, because it means that you're bottoming out and you're getting better. What you don't want to do is wait completely till all the data comes in, because most likely quantitative traders and other investors will have front run you. But you want to be forecasting ahead of time to say, okay, are we headed into a period where things look like they're going to be getting better versus continuing to be soft? And that's what Longbow does for you. So what we try to do is like telling you what the math is doing, but then we do the calculations for you. We pay for all the data for you and then give you a signal, which is really what I need. And we can look at today the overall signal, which includes the global PMI signal and 11 other signals in the Doomsday Dozen, to say, where are we on that risk profile? So right now we're at a 61. Remember yesterday, I think we were at a 63 level. So it got a little bit better, probably because equity markets went down yesterday, and they're down again a little bit today. But they're still in a cautionary zone where, people are a little bit greedy. People know, as Goldman Sachs pointed out, that earnings are not going to be great at the upcoming earnings season. They're going to call it EPS will be down 7% year over year. So there's a little bit baked into it. And people are saying, okay, maybe the Fed's going to pause. We'd have some, soft inflation numbers. Maybe they'll even reduce rates later this year. So there's some optimism baked into current multiples and current valuations here in the equities, not just in the US, but globally. So we'd caution you, going into earnings season, this isn't the time to be adding a ton of risk unless you have very strong views fundamentally on individual positions, this is the time when you want to start to be protecting and looking at things like the global PMI signal. I'll just tell you what the answer is that global PMIs have not been great. They've been getting worse. So again, we don't think here at Solstein that they've been bottoming out. We think we have, again, a little bit more wood to chop in the global PMIs before things get better, because we haven't hit the credit crunch yet. But once we do, and ahead of that time, we'll be letting you know so that you can reposition your portfolios accordingly. Have a wonderful long weekend. The markets are closed tomorrow on Friday, and I'll see you back on Monday.